Snowflake stock analysis is the topic of today's presentation. And if you're somebody that's invested in Snow stock or thinking about investing in Snow stock, then you'll want to watch this because we're going to go over some key metrics that any Snowflake investor ought to be paying attention to. Now, we came across this company while doing research about how we might be able to invest in big data, and there are quite a few reasons why you might want exposure to big data, the biggest and most visible being the emergence of generative AI, because AI algorithms are only as good as the big data that you feed them. And the idea is, ARK will tell you that a company's big data, their proprietary big data sets, are what gives them a competitive advantage when it comes to wielding AI as a competitive advantage. Now, we've written a lot of pieces about investing in big data, for example, Confluent and their real-time data analytics solution. So each of these links you see here leads to a research piece. Of course, you can't click them, but I'll put links to these pieces in the description of this video. Then you have Pure Storage and their Flash native architecture. Of course, there's NVIDIA and their data center hardware. I suppose you could throw AMD into that mix as well. Then you have data center REITs, which we wouldn't invest in for reasons presented in that article. And then you have data warehouses, which are outdated, and Snowflake is now the modern data warehouse with a lower total cost of ownership. That's very important to note. And when you look at this magic quadrant for cloud database management systems, it places Snowflake, you see there, highlighted in yellow on the lower left of all the companies here, highlighted in yellow that are leaders. The other names include Amazon, Microsoft, Google, hyperscalers, and of course, Oracle, which is an OG when it comes to database management systems. Now, back in September of 2020, we wrote about why Warren Buffett is buying Snowflake stock, and I think that this describes the thesis pretty simply. So Snowflake is clearly stealing market share away from the "we've always done it this way" types like Oracle, a company that's been the leader in database management solutions for a very long time. Gartner's report on at least the one that they produced back then that accompanied their magic quadrant said that Oracle's pricing and licensing practices continue to be poorly thought of. Well, even as far back as I can remember using both Oracle and Microsoft platforms when we were building large-scale applications, Oracle was the lesser to be liked, and it was always like, well, you have to use Oracle, and it's just that way, and they didn't really have any sort of sense of urgency about fixing some of the problems in terms of their architecture, pricing, and licensing. But now they're having to compete with the three large hyperscaler cloud providers, Amazon, Google, and Microsoft, and these are the three providers that Snowflake uses for their cloud platform, which is essentially, as we said, a modern day data warehouse. And this study, commissioned by Forrester, so take it with a grain of salt, looked at a number of clients of Snowflake and looked at the benefits they realized after deploying the solution. And you can see here on the left, the total costs were $3 million and the benefits $21 million, the present value of costs and benefits. On the right-hand side, you can see we've highlighted ones that are really easier to quantify: simplified data operations, infrastructure and database management savings. And then you have ones on the left. I mean, how do you quantify accelerated time to market or increased profit or improved decision-making support? These are things that are more difficult to quantify, but clients ultimately will be the judges of whether or not they want to increase spend on the platform, and one metric for that is net retention rate, which Snowflake absolutely dominates in when it comes to their 150% plus metrics there. So I wanted to touch on Snowflake's recent Investor Day. So this was just last week. And in the fourth quarter of 2023, they had talked about how Snowflake data will be a very, very big driver of a large language model in conjunction with many, many other data sources. Fast forward to this last quarter, and their CEO and fearless leader pretty much leads off his remarks on generative AI and spends half his intro talking about the company's experience in that area. And their Investor Day deck followed suit. That's what we use to look at for this presentation. And what's interesting here, when you look at the agenda, there's the chairman and chief executive officer of Microsoft talking alongside Snowflake's chairman and chief executive officer. So that's pretty interesting to note. Now, we're not going to dig into all the banter they had around generative AI and how Snowflake expects to benefit from that. You can find that research in a piece that we just published titled Snowflake Dives into the Generative AI Data Pool. And you can go ahead and read that. It all comes down to this: Snowflake's AI applicability in a nutshell is that a AI strategy requires a data strategy because algos are only as good as the data that you feed them. So we're not going to focus on that for this presentation. We're going to instead look at some key metrics. For example, the Forbes Global 2000 penetration is a metric this company likes to use, and you can see how in fiscal year 2021, Q1, they had 16% of those clients, and now they have 30%. So 600 of the 2,000 members of the Forbes global list are spending money with Snowflake. Now, you might not know much about that list, but here's something that will put that in context. So our recent presentation on global stocks pointed out how MSCI ACWI, that's a global index which represents over 95% of the investable universe, contains 3,000 stocks. So 2/3 of that is actually, that's a pretty formidable number when it comes to market cap, collective market cap of total global market cap. And Snowflake takes a land and expand approach. So they want to get as many of those people spending money as possible and then increase that spend over time. And when you look at the breakdown of the Forbes Global 2000, you can see that it's quite diversified. So sure, it's dominated by the United States, but in second place there is Japan and the United Kingdom. Now, when you look at revenues for Snowflake, 80% of their revenues come from the United States. That's geographical concentration risk that we'd like to see them get away from. And you can see the growth in EMEA and APAC and Japan. In our previous piece, we talked about how they were really trying to grow international revenues. Now, getting back to their customers, they start them small. So the median initial capacity contract size for customers with over $1 million in product revenue, that's what they refer to as opposed to services and product revenue dominates their total revenues. But the average spend there is small. It's $150K a year. And then they work them up from there. And here you can see the time it takes for that to happen. So they start them out at $150K. And then these are, the business model here is different. So whilst most SaaS firms use a fixed price per year, Snowflake takes a consumption approach to spend, which is actually quite good if you're a CTO and you want to pay for what you're using. So here you can see the amount of time it takes, 240 days for the average client to hit that 150K run rate. Say, wow, we've hit that consumption level. Now we need to up that. And then they increase their spend. And this chart here shows how customers are spending more over time in these various buckets. And the legend is actually missing here. It would be useful to see. I believe the gray, for example, is $20 million. The dark blue there, the 330 number, that's, I believe, $1 million. So you have, yes, that's correct. We have 420 customers paying more than $1 million per annum. That's pretty good. And you can see over the years how these numbers are growing. That's exactly what you want to see. And this is a reflection of their strong net retention rate. That's the percentage increase over time that your existing clients are spending with you. So on average in the SaaS world, I believe it's somewhere around 120%. For Snowflake, it's quite high, and you can see on the left here they've shown their net retention rate across all clients, and they explain that decline by saying the macroeconomic headwinds that are affecting companies everywhere and causing CTOs to tighten their purse strings. That means that companies are, taking archived data and essentially cleaning up their data warehouses so they're not using as much data spend as they were before. And that's actually a good thing because it shows that they can contract when they need to. And then to the right here, you can see the net retention rate plotted for the Global 2000. In other words, their large clients aren't cutting back on spend nearly as much as their total universe of clients. Now, I wanted to touch on something that's quite important, and it came up when we were doing our research piece. It's tempting to look at their operating losses and assume that $842 million was burned in fiscal 2023. So you can see that's what their operating losses were. But you need to be careful there, because if you back out stock-based compensation, you can see that's done here. You see the line that says stock-based compensation related charges. Well, if you back that out, then they're actually operating profitably. What you need to realize here is that SBC, stock-based compensation, is non-cash. So when we're looking at firms and how much cash they're burning, that's very important. We don't look at income because that can be confusing for the reasons that we've noted here. We look at operating cash flows. These are what we use to calculate runway, the idea being that if a company needs to raise more money, they have to give away equity or take on debt. Now, Snowflake actually had positive operating cash flows of $545 million in fiscal 2023. So getting back to the stock-based compensation, is somewhere around 40% of revenues. I think industry average in the tech world is 20%, so it's quite high, but we'll touch on that more in a second. So when we talk about operating cash flow versus net income, they might seem like the same thing, and I always hate throwing these terms around because most people don't know or care to know what these terms mean, but the distinction between them it really comes down to the accounting methods used. So on the right-hand side here, you can go to Yahoo Finance and pull up these little charts for any stock, and it shows you the net income there in blue. So you could see that negative net income approaching it should be over $800 million. And then you can see their revenues, right? Operating cash flow can be found somewhere else. So just to explain this very quickly, net income uses the accrual method and it records sales and expenses when transactions or productions occur, even if cash wasn't received or paid. That's why it's important to pay attention to cash flows. This means some items in a company income statement can be non-cash. We just showed you an example of that. Now, operating cash flow counts only cash as it's received or paid out. So it's a pure way of looking at a company's burn rate. And looky here. So this was the above table here was taken from Snowflake's recent deck, and it shows the net cash provided by or used in operating activities. And you can see, moving from left to right, in fiscal year 2021, they were still burning cash. That year, they burnt around $45 million. In 2022 fiscal, they had generated $110 million from their operations, and then this last year, $545 million. You can go look this up for any firm in Yahoo Finance, and our recent piece on stock analysis for beginners focused on how you can use Yahoo Finance. It's freely accessible to pull up basic metrics like this. So if you go to, you click financials, then cash flow, and you can change this to quarterly or annual, and then you can see how those numbers there from Yahoo Finance match the ones that we pulled from Snowflake's deck. So just getting back to stock-based compensation. So they explain it here as R&D representing 61% of the total equity grant dollars last year, new hires representing 56%. They're investing heavily in talent, in R&D especially, to make sure they're staying one step ahead of the competition. That's what they need to do to outsmart or outcompete some of the biggest companies in the world. And investors certainly ought to be concerned about dilution, and they have a slide that addresses the bigger stock-based compensation picture, which says, sure, we had 3% dilution last year, but we're going to push for a 2% annual dilution target going forward. So that's good that they see that concern and they address it. That's very important. Now, when it comes down to valuing Snowflake, we use a simple valuation ratio, which is market cap divided by annualized revenues. You can see for Snowflake that comes out to be about 24. Well, our catalog average, where we have a Microsoft Excel catalog of over 460 tech stocks, and for a fair number of those we calculate this number, and the average is around 6.5. We have a hard stop at 20. We won't invest in firms that have a valuation higher than 20, a simple valuation ratio, I should say. We'd add to Snowflake, so we're holding it. People often ask, well, why don't you ever have presentations on stocks that you're holding? Well, this is one. So we'd add to our Snowflake position, and we have money left to allocate at an SVR of less than 20. So when those dips happen, we'll send alerts to our premium annual subscribers. We'll do that for any stocks we buy or sell, along with the reasoning behind each decision. We don't have a magic 8-ball that we use to make investment decisions. We articulate in lengthy research pieces the reasons why we buy a stock. That's stocks we love. We think about buying a stock. That would be stocks we like, or stocks we avoid that we wouldn't think about purchasing, usually because of showstoppers or some set of red flags. So to conclude, Snowflake retains their consistently rich valuation over time. You won't often see it dip below 20, and when it does, we take advantage of that. It's not to say it won't dip well below that for any reason. There's always company-specific risk, but Snowflake is certainly one of many good SaaS companies out there. It's one of 37 tech stocks we're holding. You shouldn't be trying to find the next Tesla, Microsoft, or NVIDIA when you look at Snowflake or any stock out there, disruptive tech stock. That's not how you build wealth. You're simply looking to hold a portfolio, a diversified portfolio. If you're a risk-averse investor, you follow that sort of strategy as we do, then Snowflake would be there's a reasonable thesis to be held here. They appear to be holding up well following the recent macroeconomic headwinds. And getting back to that mention of generative AI, you can read our article on that. I would conclude there that all this generative AI banter is just that. It's banter. And when it comes down to it, even without their recent conversion to generative AI religion, this is still a fairly solid company to invest in for all the reasons that we've laid out in past research pieces. So I'm going to put up another video for you to watch, but before I do that, please click the Nanalyze logo here on the right, subscribe to our channel, support our work. Thanks for taking the time to watch this today.